I mean, one of the unknowns, of course, is whether the Saudis stick to their guns or whether pressure is brought to bear and they back off this move, which is a self-inflicted wound as well. But I'm going to just bring you back to, and I take your point, I think it's an important one, that trying to kind of find any sense of fundamental value or logic in price moves on a day like this can be difficult at best and certainly dangerous at worst. But I'm just looking at my screen and seeing, Enbridge down almost 13%, CNQ down 23%. Suncor is off almost 16%. And I'm saying, unless these are companies, we can check them individually, but that are leveraged up in a way that they can't survive, a short term of cash flow interruption or decline, these seem like at some point, some investors might say there's buying opportunity here.
Yeah. So first thing I would say at a very generic level, capital has now become extremely cautious. So new capital that's going to go back in the market is going to look for flight to quality and liquidity. It happens every single time this occurs. It will happen this time again. So those companies that are quality and liquidity, which you named a few of them there, are going to be where capital goes. Funds flow are what moves markets higher. So we need to go where the funds are going to flow. So stick to that first. Secondly, on the producer side, stick to lower decline rates. And lower leverage, because there are companies, and especially in the US and some in Canada, where you have to spend money to maintain your production, and you actually have a negative return on the money you spend, and so they will not spend, and then their production is going to collapse, and they're not going to be able to maintain their debt, and things spiral downward. There are a lot of companies like that in the US. There are some in Canada, but stick to low decline rates, unlevered balance sheets, as low a leverage balance sheet as you can, and companies that have room to manage that. I think that's a very prudent path. And as you mentioned, when stocks are down, some of these stocks that look like prudent investments, they're down 40 to 50% today. In the long run, that's going to look very good. And Amanda, just to be clear though, some of these higher decline rate companies, their cash flows today on a more normalized price, and I really do believe a more normalized price is going to be, say, over the next 3 to 5 years, the more normalized price is going to be $50 to $60. These companies are trading at 1 times that cash flow today. Now, what they look like after is interesting, but over the next 3 to 5 years, these companies could trade back to a 3 to 5 times cash flow. Well, that's 300 to 500% returns. That is ridiculous. It's a generational opportunity if you do it right and if you do it smart.